Standard & Poor's has downgraded France's credit rating.
Yeah, that's right. The ratings agency has downgraded France by one notch from AA+ to AA. They said this is because of lower economic growth, which is hampering the French government's ability to cut its budget deficit. Standard & Poor's, of course, was the first ratings agency back in January 2012 to strip France of its AAA top-rate credit rating. That's the rest of the rating agencies followed suit. Since then, the French government has long since criticised the ratings agencies and the methods they use in calculating their ratings. There's been a reaction this morning from the French finance minister. He said in a statement that he regretted what he called the inaccurate criticisms being made by Standard & Poor's, reminding observers that during the last 18 months, the French government has implemented major reforms aimed at improving the economic situation in France. Well, for more on this, let's go to London and speak to Ishak Siddiqui, who's a market strategist at ETX Capital there. Ishak, thank you for joining us. Things had seemed fairly quiet on the Eurozone front, really. Should we be surprised by this downgrade of France?
I don't think so, no. I think rating agencies are quite well known to be behind the curve, taking action a lot later than many people expect. I think rating agencies are quite, instead of being active, they're reactive to what's going on in the Eurozone. I think a lot of people are now going to question how much the European Central Bank knew about this, given that we had a rate cut yesterday. On the whole, the news has tempered the market this morning. We're seeing a drop-off on the CAC 40. We've also seen the 10-year French bond yield inch up higher, and we're also seeing pressure in the euro. So it is a resurgence of the Eurozone worries, but perhaps not enough to really worry the market too much in the long term.
And is this in line with the strategy we've been seeing of markets? You know, they've largely priced in these downgrades now. They're not so worried when they do happen.
Yeah, no, absolutely. I think you got a very fair point. There was a time before the crisis that whenever rating agencies would take action, we'd get very worried about it. But now it seems to be very much priced in. I think looking at it on a broader scope, Germany seems to be the only country that's retained its AAA rating. Now France has had the cut, and there are going to be continuing worries about the Eurozone, particularly the high unemployment levels, and that's one of the reasons why S&P made the move. It was due to the high unemployment in levels in France, and also the structural problems, including taxation. So there's a lot of work for the French government to reassure the market and credit rating agencies that they're on top of their reforms. Thank you.
We're seeing a lot of the banks this morning being hit by that trading too. Is that where we should be worrying about as the trading day continues?
Yeah, I think so. Look, we're going to see a bit of uncertainty heading through the course of the day, and that's mostly because we've got these non-farm payrolls coming out from the US. I think when it comes to the banks itself, they had a pretty mixed performance during the last earnings season. French banks have been also quite mixed. BNP Paribas had a pretty good set of results. So I think we should take away some of the uncertainty from the banking sector today. Mostly it's going to be just a bit of volatility and turbulence ahead of the payrolls data, which is going to give us more of a stronger signal to what the Federal Reserve is going to do in the coming months.
Okay, Ishak Siddiqui in London, thank you very much for joining us.
Thank you.
Now let's have a look at the rest of the markets now.
Yeah, well, as Ishak was just telling us there, Paris's CAC 40 opening down, perhaps not surprising after that downgrade from the ratings agencies. The banks, as I was just saying, worst hit, they're seen as the ones to be most likely to be affected by a sovereign credit rating downgrade. Not a great picture in London or Frankfurt either, both of those markets opening in the red. Over in Asia, we saw the Asian markets taking a negative lead from Wall Street on Thursday. Investors over there watching very closely what the Chinese government is going to announce of its plans for the world's second largest economy after its meeting this weekend. They're also digesting figures showing that exports rose in China by 5.6% in October, more than we had been expecting.
Next to the story that set the business world a Twitter this week.
Yeah, and not surprising, really, after the first day of trading for Twitter on Wall Street, their shares closed up 73% on the initial purchase price. We can see how that tracked out there, a fairly significant spike, closing just under $45. Not bad for a firm that's not even 7 years old and has yet to turn a profit. But what next for Twitter? Well, Mark Edwards has been finding out.
Day one as a publicly traded company, a roaring success for Twitter. The 7-year-old microblogging site saw its stock price soar over 70% from an initial public offering price of $26. But some analysts aren't convinced that Twitter's stock won't suffer the same fate as Facebook's, which plummeted just after its IPO and didn't recover for months.
Twitter really has to make sure they perform well. Quarter by quarter, they're going to have to show increases in user engagement and user growth. Twitter's going to have to show a move towards profitability and a reduction in the expenditures that they have.
Twitter hasn't turned a profit since its inception in 2006. Its most recent results are worrying. Despite doubling their turnover to $422 million for the 9 months ended September, the company said it lost $134 million in the same period. A growing concern for Twitter now that it has shareholders to answer to, particularly those investors looking for returns on what many see as premium rates for the stock.
But nobody's buying this at $45, $46, $47 with anything other than just getting carried away in the excitement. These are $2,000 Super Bowl tickets or Rolling Stone tickets at this price.
But for the moment, the future is bright for Twitter. The coffers are full, and unlike Facebook, it's earning most of its money from the lucrative mobile market. And above all, they've got 230 million internet-savvy users to rely on.
Back in Europe now, and a surprise decision by the European Central Bank.
Yes, Mario Draghi said that he would cut the benchmark interest rate, rather he did it in an announcement on Thursday, to 0.25%, a record low for the European Central Bank. He says that's because inflation in Europe took a tumble and is down to 0.7% in October, way below the bank's target of 2%. It's a sign of weakening demand in Eurozone economy, something that leaders are very worried about as they're trying to bolster economic growth. But some analysts say that there isn't much more the ECB can do.
The cut in interest rates came as a big surprise for the markets because we didn't think it would be necessary to cut the rates at the moment. And now the European Central Bank has nearly used up all of its resources. So I'm curious about what the ECB can still do if it needs to stabilize the markets.
Thank you for that business update, Stephen Carroll.